Return on invested capital versus return on capital employed. One of the biggest confusions in finance. Let's take a look at this today. Most people treat ROIC and ROCE as the same, and that is where the confusion starts. They look similar on paper, but they answer very different questions. If you think like an investor, you need to understand this difference very clearly. Well, both the metrics are useful, but not in the same way. And if you mix them up, you could make a wrong call on the valuation or strategy. ROIC is definitely not equal to ROCE. The idea is to think like an investor, and then moving on, let's try to focus on what exactly are we really trying to solve. Both metrics talk about how a business uses capital, but their focus is different. ROCE measures operational efficiency, whereas ROIC measures value creation. This difference matters when comparing companies or building valuation models. Always ask, am I checking efficiency or am I checking value creation? The metric you use depends on the answer. ROCE goes for efficiency, ROIC goes for value creation. Moving on, let's check the first thing, the return on capital employed. Start with the ROCE. The formula is EBIT upon total assets minus current liabilities, or the other version is EBIT divided by equity plus long term liabilities. It tells you how much operating profit a company earns from its total capital base. Simple, useful, especially for asset heavy industries like manufacturing or infrastructure. Think of ROCE as a measure of how well the company uses all its capital to generate operating profit. ROCE is simply EBIT upon total capital employed. Next, when to use this ROCE? ROCE is best used when you're comparing companies in the asset heavy sectors where assets drive operations. When you want a benchmarking tool for efficiency, it is perfect for peer comparison in industries where physical assets matter the most. Keep this in mind. Yeah. Next, look at this next ratio, which is ROIC, return on invested capital. The formula is NOPAT, which is nothing but EBIT into 1 minus tax, divided by equity plus interest bearing debt minus excess cash. Did you notice the difference between the two formulas? Here, ROIC removes the idle cash. It focuses on the capital which is actually invested in the business, and it gives you the after tax return on that capital. This is a purer measure because it ignores the idle cash. It asks, how much return did we get on the money that is truly working in the business? As simple as that. Yeah. Now, coming to the next point, important one, when to use ROIC. ROIC is what you use when first evaluating capital allocation decisions. Next, checking if returns are exceeding your cost of capital. Third, measuring the value creation for your shareholders. Yeah. For intrinsic valuation methods like DCF, ROIC definitely matters more than your ROCE. Yeah. Why? Because always you compare ROIC to WACC, and that tells you if the company is compounding or destroying the value. The simple thumb rule goes like this. If your ROIC is greater than WACC, it means there is a value creation which is taking place. Your company is creating a value for the investors. And if ROIC happens to be less than the WACC, it implies that the value is getting destroyed. There is something wrong with this business. Focus, deep dive into the details. Yeah. Next, let's try to figure out what exactly is the real difference here. Yeah. The ROCE shows how efficiently the capital is used. The ROIC shows whether the company is creating the value after accounting for the real cost of that capital. Yeah, you can use these multiples or these ratios for benchmarking, assessing the after tax returns, the net invested capital, the value creation investments. Again, focuses the same thing. ROCE focuses on efficiency, ROIC focuses on value. Next, watch out for this one trap. A company can have a high ROCE and still destroy value. An important interview question here. Yeah, and a food for thought. A company can have a high ROCE and still destroy value. Why? Because ROCE ignores the cost of capital and the excess cash. If ROIC is below WACC, the business is losing money on every new rupee invested. This is the mistake juniors make. They get impressed by a strong ROCE without asking the bigger question, what about the ROIC? What is the job that every new rupee that you invest in the business, how efficiently is the returns getting generated out of that? They forget to ask this question. Simply, high ROCE does not necessarily mean there is a value creation. Yeah. And that is where the real test takes place of ROIC versus the WACC. That's what the true test of assessing whether the value creation takes place or not. Yeah. Finally, there are final thoughts on this. The memorization of formula is a different story. It's easy, but the actual skill is knowing when to use which metric. Yeah. ROCE, as I've been telling you earlier, ROCE is for efficiency comparison. ROIC is for value creation. Yeah. If you want to think like a banker, always look at the context, not just the calculation. Yeah. So yeah, this is how I teach. If you like this video, please share this video with your friends like this, and definitely subscribe to this channel. This is Pratik signing off. Thank you.